One of my favorite long-term dividend growth stocks is Visa. That is stock ticker V, and they're currently trading at about $278.67 per share. And when I say this, people oftentimes get pretty confused because when you look at that starting dividend yield for the company, it's sitting below 1% at 0.75%. But in this video, I'm going to show you why I think Visa could be a good holding if you're a long-term dividend portfolio. I'm going to be talking about why it's very clear they have competitive advantages, talking about their growth runway, and then of course, jumping into my stock valuation spreadsheet to see if we can calculate the intrinsic value. And like always, if you'd like to download any of my spreadsheets, then you can head over to tickerdata.com at the link in the description. So let's go ahead and dive in. Now we can see Visa over the past year, the company's up around 23.7% and year to date up around 7%. Now for me personally, Visa is actually a position I've held in my portfolio for quite some time now. And in fact, let's go ahead and zoom in. If we come over here and look at my growth chart, we can see Visa listed out right here. I'm up about 40% on this position. And when I originally started adding to this position, I added at around $180 per share. But since then, my cost basis has increased as I've continued to buy new shares over the past few months. Now, if we scroll up just a little bit, we can see right here, my allocation in Visa, currently about 2.7% of my portfolio. Long term, I'd like to see this increase by quite a bit. And for example, we can see Microsoft, my largest individual holding, is around $13,800 in my portfolio, around 7.8%. I could easily see me wanting to get Visa to that same size. Now again, why would I want to do this? Why would I want to do this for a stock that only has a starting dividend yield sitting at 0.75%? Well, let's look at this company from a dividend perspective. If we jump over to my dividend breakdown sheet, we'll come over here, plug in stock ticker V and hit enter. And you can see thanks to the ticker data add-on, all this data is going to automatically load in. Now, like we've already touched on, low starting dividend yield sitting at 0.75%. But we have to understand, where did dividends come from? Dividends are paid out of free cash flow. So for companies to continually increase the amount they pay out in dividends, we need to look for growing free cash flow. And over the past decade, the free cash flow from this company has absolutely exploded. It's up around 22.68%, and over the past 5 years, up about 10.5%. So if we come down here, look at this. In 2013, the company generated about $2.5 billion in free cash flow, and in 2023, that jumped all the way up to about $19.7 billion. That is absolutely explosive free cash flow growth during that time period. And what we'll notice as a result of this, the company's able to increase the amount they pay out in dividends every single year. So look at that 10-year dividend CAGR sitting at 17.35 and the 5-year sitting at 14.65. Again, because of the explosive free cash flow growth, we can see explosive dividend growth. Long term, you can't have explosive dividend growth without the free cash flow growth, and that is something that a lot of dividend investors seem to not understand. So we can see on a per share basis in 2013, the company's paying out around 35 cents per share. Nothing too crazy, but if we look in 2023, it jumps all the way up to $1.87, and as of right now, it's now sitting at $2.08 per share. And here's what the best part about all of this is. Even though they have rapidly increased those dividend payouts, their free cash flow payout ratio is actually below 20%. It's only sitting at 19.04%. Now, like I've talked about on the channel before, there are 5 different ways a company can use free cash flow. 1, they can reinvest back into the business, they can buy back shares, pay down debt, attempt mergers and acquisition, and then of course pay out dividends. So if only 19% of the company's free cash flow is being used to pay out dividends, they still have 81% of free cash flow left over to do those other things that I just mentioned. And for a rapidly growing company like Visa, they have to have a lot of capital to reinvest back into the business to grow at a high rate. And if we look at the free cash flow payout ratio over time, we can see for the most part, pretty consistently, this free cash flow payout ratio has stayed below 30%. That is a very healthy range. Now, what's one of the other ways this company is using their free cash flow? Well, if we jump over to my stock screener sheet, we'll come up here, plug in stock ticker V and hit enter. One of the things we can see if we come down here, the company has bought back a lot of shares over the past decade. They've gone from around $2.6 billion all the way down to around $2 billion in 2023. So they bought back about 600 million shares. That is quite a bit. Now, if you're a shareholder in the company, this is something you should be pretty excited about because it boosts all of the other per share metrics when the shares outstanding decreases. We see a boost in earnings per share, boost in revenue per share, and boost in free cash flow per share. And in fact, it actually helps the company be able to increase their dividend payouts at a higher rate. So when we see how the company is reinvesting back into the business, how they're buying back shares, and how they're paying out dividends, we get a better idea of what their capital allocation plan is. And as I was going through their investor presentation, I noticed this is actually something that they touched on, and I actually love it when companies talk about this. It helps me better understand how the company wants to reward me as a shareholder. So far, we can see in Q2 of 2024, they've generated about $4.25 billion in free cash flow, and year to date for 2024, it's It's about 7.6 billion. Now again, how are we being rewarded as shareholders? Well, we know they're heavily reinvesting back into the business, but we can also see we're being directly rewarded mainly through share repurchases and then dividend payments. As of right now, we can see share repurchases are more of a focus for this company. And in Q2 of 2024, they used about 2.7 billion to buy back shares, and they used about 1 billion to pay out dividends. So again, based off this data the company's given us, we can see share repurchases are more of a focus for the company right now, and we can see year to date the company used about 6.1 billion to buy back shares and about 2.1 billion to pay out dividends. Now again, for me, as someone who is a long-term investor, Visa using more capital to buy back shares rather than paying out dividends doesn't really bother me because it actually increases their ability to pay out more in dividends long term. This is something I talked about on my second channel, Ticker Data, talking about the magic of share buybacks. I'll put a link to that in the description if you want to better understand what I mean by this. Now, when we hear investors talk about Visa, when we read articles on them, one of the things you hear a lot of the times is that they have a competitive advantage. And we hear people talk about this with other companies all the time. We talk about Apple and their ecosystem. Maybe we talk about Starbucks and their customer loyalty program. But what a lot of people don't understand about competitive advantages is that there are two key metrics we can actually look at to understand if a company has a competitive advantage. So despite the company or the industry that they operate in, these two key metrics usually tell us whether or not a company has a competitive advantage. Now, the first one is actually on our stock screener, and that is return on invested capital. And basically this tells us how profitable are the projects that the company is investing into. And typically speaking, a decent return on invested capital for most companies is going to be 10% to 15%. But when we look at Visa, look at the most recent year, we can see in 2023, the return on invested capital was sitting at 29%, 2022, 26.74%, 2021, 20%. So the projects that this company is investing into are highly profitable. This is going to lead to great long-term returns for the company. Again, this is the first sign that this company may have competitive advantages. Now, what is the second key metric? Well, to see this, we need to jump over to the profitability sheet. And we can see up here, we've already plugged in stock ticker V. Now, the second key metric that usually tells us whether or not a company has a competitive advantage is the gross profit ratio. Now, what exactly are we looking for? And the gross profit ratio can vary a lot depending on the type of business that we're looking at. And for Visa, we can see they actually have an extremely high gross profit ratio. That's a phenomenal sign, and it is a good sign that they may have a competitive advantage, but there's something equally as important, and that's that we can see it's staying steady over time. We're not seeing any large declines year over year. We can see the 10-year average gross profit ratio sitting at about 80.8, and in 2023, it's sitting at about 79.9. So over the past decade, there's essentially been no difference in the gross profit ratio. It stayed steady for the entirety of this time period. So really, when we talk about Visa, this kind of tells us their business hasn't really been disrupted in any way over the past decade. Think about all the other payment processors that have grown in popularity during this time. We have Venmo, companies like PayPal. Despite the growth that those companies have seen, Visa has been able to maintain their steady gross profit ratio and a really high gross profit ratio. So when I can see consistently high gross profit ratios and high returns on invested capital, I can feel pretty confident the company I'm looking at has somewhat of a competitive advantage, and I definitely think that is the case for Visa. Now, if we look at some of the other key metrics here on our profitability sheet, we can see revenue growth has been really good over the past decade, about 10.74%. If we look at net income, sitting at about 13.24%. All of those are phenomenal metrics. So when we look at these historical metrics for Visa and look at them over the past 10 years of about 427%, we have to ask ourselves, is that same growth runway still possible for them over the next decade? Will they be able to see these same rates of return? Well, we have to look at the growth runway for the industry that they're operating in. And this is something I've talked about when talking about Visa and talking about MasterCard before. But here's what's really shocking about this. If we look at the digital payment market in 2022, it was sitting at about 84.5 billion. That's a pretty large market size. But if you look at the projection for 2032, it's sitting at 505.3 billion. This is pretty shocking. That's a compounded annual growth rate over a decade of 19.7%. So this market is going to absolutely explode over the next decade. And here's the beautiful thing about this. Visa is the largest player in this market, so they're definitely going to be a beneficiary of the growth in this industry. So with all this being said, we like the fundamentals of the company, we like the growth runway, but we still have to ask ourselves, is the company trading at a good value? We could buy the best company in the world, and if they're trading at too high of a value, we still won't see great returns. So to answer this question, we need to jump into my stock valuation spreadsheet. We'll go ahead and come up here and plug in stock ticker V and hit enter. And you can see all this data will automatically load in. Now, the company has a beta sitting at about 0.97, so the volatility should follow that of the market pretty closely. Now, the first valuation that I want to look at is going to be Graham's valuation. Now, if we zoom in, essentially what Graham's valuation does is it values a company based on the earnings per share and the projected earnings per share growth, while also taking into account current market conditions by looking at the current yield of AAA corporate bonds. Now, what I want to plug in is the estimated earnings per share average projected for 2024. And with the ticker data add-on, we can pull this in pretty easily by using the ticker data function. We'll come over here, plug on Visa, click on estimated earnings per share average, and we want it for 2024. So I'll plug that in and hit enter. And we can see the estimated earnings per share average from analysts is sitting at about 9.95. So I'll go ahead and plug that in, and you can see we already have our growth rate projection for the company and the current yield on AAA corporate bonds. And we can see the end result of this is going to give us an intrinsic value of about $210.39. This is a decent bit lower than the current trading price, and a huge reason behind this is, again, current market conditions. The current yield on AAA corporate bonds being quite a bit higher than it has been historically over the past decade is going to drive down this valuation pretty radically. Now, if we keep moving forward, the next valuation we'll look at is our discounted cash flow analysis. And what this does is it values a company based on how much free cash flow they're going to produce in the future. So assuming a free cash flow growth rate of about 11.5% after adding the company's cash and cash equivalents, subtracting out the total debt to get equity value, dividing by shares outstanding, we come to a DCF price per share of $291.11, which is actually a little bit higher than that current trading price. Now, the next valuation we'll look at is going to be our multiples, and this values a company based on their price to earnings multiple by comparing their price to earnings multiple to the comparable companies. So we can see the average PE for these comparable companies for Visa sitting at about 34.25. So historically speaking, they do have pretty high price to earnings multiples. With the earnings per share of 8.3, Visa's intrinsic value based off this model would be $284.31. Again, a little bit higher than the current trading price. Something else I also want to point out, if we jump back over to Seeking Alpha, click on valuation and scroll down, one of the things we can see, price to earnings non-GAAP for the trailing 12 months for Visa, sitting at 29.61, but when we look at the 5-year average, it's sitting almost at 34. So even though the company is trading pretty close to its 52-week high, we can see compared to how it's historically traded, it looks like it's a little bit undervalued actually. That's pretty interesting. Now finally, if we jump over to our last valuation, it's going to be the dividend discount model. And this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. We look at these year-over-year dividend growth rates. We have about 9.5%, 18%, 19%, 11.2%. All very high dividend growth rates, and long term, I think they can achieve a dividend growth rate of 7.75%. So assuming a discount rate of 8.5%, we come to a dividend discount model price per share of $298.83. So when we jump over to the output tab, we can see the 4 different valuations that we use: Graham's, multiples, DCF, and dividend discount model. When we average those 4 together, we come to an intrinsic value of $271.16. So the difference in the intrinsic value and the current trading price is only about 2.77%. So with a 10% margin of safety, you get an acceptable buy price of about $244.05 per share, and with a 20%, sitting at about $217. Now, one of the things we also have to understand about this company, though, is it tends to trade at a premium. This is a high quality company that we're talking about for all the reasons that I mentioned earlier in this video. And this reminds me of the old Warren Buffett quote that I definitely think applies to Visa. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Visa is no doubt a wonderful company. The share price returns over the past decade definitely showed signs of that, and when you dig into the fundamentals, you can see that that is true. They have phenomenal rates of return on invested capital, very steady profit margins, and the dividend growth and free cash flow growth will be phenomenal over the next decade. So again, when I think from a long-term perspective, my end goal, wanting to live off dividends, even though they have a low starting dividend yield, I know if I buy into this company, I'm going to see phenomenal dividend growth over the next 10, even 20 or 30 years. And along with that free cash flow growth will come share price appreciation. So go ahead and let me know in the comments down below what you think of Visa, if you plan on buying or selling. Like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.